Hi there, welcome to my channel where I dive into fascinating economic trends and analyze their impact on society. In today's discussion, which is part 1, I shall be concerned with the role of money and finance in the process of economic development. Essentially, I shall be looking at the economic foundation of banking, that is, the processes of saving, investment, economic growth, and financial development. In future episodes, I shall look at other aspects of financial intermediation, including decentralized finance, DeFi, financial inclusion, and so on. Before I continue, however, do visit our website where I curate news and publications from international financial organizations and world central banks. Please also subscribe to this channel and be informed whenever we publish a new video. To begin with, let me state my framework. First, the real sector has its counterpart in the financial sector. Note here that I'm not implying any causal relationship. Second, the increasing sophistication of the financial structure is part and parcel of the process of economic development. Third, my primary concern and therefore focus is with the domestic financial sector. In the early stages of economic development, that is, when barter and subsistence activities are still dominant, the financial structure is either non-existent or it is very unsophisticated in nature and form. Under these conditions, the same economic unit carries on saving and investment, and often these are in real terms. For a variety of reasons, which I shall presently discuss, this financial process is very inefficient and it contributes to slow development. First, under such subsistence conditions, no investment may be undertaken without prior self-saving. Because of this, economic growth is constrained, not only to the extent that investment can only be undertaken after some time lag, that is, time taken to accumulate the desired amount for investment, but it is also constrained by the amount it is possible to raise by the individual unit. Indeed, to the extent that the return to saving is likely to be low under self-finance, less will be saved. Second, according to Coates W.L. Jr. and Cathcart D.R. in a 1980 paper titled Money and Monetary Policy in Less Developed Countries, Survey of Issues and Evidence, and I quote, "Those individual economic units endowed with entrepreneurial talents and drive are not generally the same units with surplus resources to invest, and therefore economic growth fails to reach feasible rates as savings either remain sterile or are misallocated." End quote. Third, since self-finance is likely to be in real terms, this ties down real resources that could be used more profitably elsewhere in the economy. Thus, costs, which include opportunity costs, storage costs, spoilage, and so on, are incurred. At this stage of economic development, the only alternative to self-finance is direct finance or direct lending borrowing. In this neighborhood market, where the spatial limits result from and are determined by the need to have personal knowledge of the borrower, intrasectoral and or intersectoral flows take place based on direct contact. That is, surplus units lend directly to deficit units, and often these transactions are not recorded anywhere except in the minds of the participants and perhaps some witnesses. It is only when indirect finance develops and money itself gains more acceptance, that is, through the process of monetization, that economic development really takes off. According to Coates and Cathcart, and I quote, replacement of direct lending by bank intermediation raises the ratio of money to national income, which implies the release of real resources. It follows that in such a context, money creation itself is the channel of transferring surplus savings to investing sectors. The real resources freed in this way reflect the real quantity of money willingly held and hence cannot be forced by simply supplying more nominal money. End quote. Thus, financial intermediation, as this process of indirect finance is called, is at the very center of the whole process of economic development. Financial intermediaries act as the middlemen of finance. Instead of lending directly to investors, savers lend to financial intermediaries, who in turn lend to investors. Lenders, savers, get an interest, the deposit rate, on their savings, and borrowers are charged an interest, the loan rate, on the money borrowed. Typically, deposit and loan rates are not the same, with the deposit rates being lower than the loan rates. The spread between the two represents the returns to the financial intermediaries. Of course, in a sophisticated market, the process of lending, borrowing can be carried on simultaneously. Indeed, financial intermediaries can create credit against themselves and through the so-called bank deposit multiplier. Over time, financial intermediaries grow their balance sheets to such an extent that they can undertake investments of their own. Foremost among financial intermediaries are banks, although non-bank financial intermediaries, NBFIs, have also grown in size and influence. I shall turn to a consideration of financial intermediation and its relation to economic development. There are several approaches to this issue. Here I shall consider the effect of financial development on economic growth and the implications of financial repression for both saving and investment, and ultimately economic growth. Some economists, in the process of analyzing this relationship, consider the question of causality. That is, whether economic development causes financial development or vice versa. Some economists favor the view that financial development causes economic growth, while others favor the opposite view. Although I'm inclined to agree with the former view, I would not dismiss the impact of economic growth on financial development. Although I give precedence to supply-leading phenomena in the development of finance, I do not ignore demand-following ones. Therefore, to some extent, there is two-way causality. It is the process of incipient monetization that fosters economic growth. Then financial relations become more sophisticated as new ways of saving, lending are developed, along with the development of financial intermediation. Financial intermediation results from the specialization that is engendered by the division of labor in higher economic forms. Thus, just as the Smithian division of labor in the real sector and the resultant specialization meant more efficiency in production, even in the financial sector, the efficiency resulting from financial intermediation raised the amount of financial assets, including money and near monies. Drake, P.J., in a 1980 paper titled Money, Finance and Development, identifies three aspects of the division of labor in the financial sphere that result in greater economic growth. First, there are the benefits from monetization that I discussed in part 2 of the series on money. Second, there are the benefits resulting from the separation of the saving and investing unit. That is, to the extent that self-finance is eliminated. According to Drake, and I quote, "If economic units rely entirely on self-finance, investment is constrained in two ways: by the ability and willingness of any unit to save, and by its ability and willingness to invest. The unequal distribution of entrepreneurial talents and risk-taking proclivities in any community means at one extreme there will be some whose investment plans may be frustrated for want of enough savings, while at the other end there will be those who do not need to consume all their incomes, but who are too inert to save or too cautious to invest the surplus productively. For the community as a whole, productive investment may thus fall short of its potential level." End quote. The important factor here is the existence of channels whereby pooled resource surpluses from other units may be channeled to deficit units for investment purposes. It matters not really whether this is done directly or through intermediaries. The third and most sophisticated form of division of labor is that of indirect finance, whereby specialist institutions act as middlemen in the financial process. Just as monetization circumvents the problem of the double coincidence of wants, of barter, indirect finance also removes the marrying difficulty that the direct form of finance imposes. But more fundamentally, such specialization results in economies related to data collection, specialist personnel, fractional reserves, etc., such that financial institutions can offer competitive deposit rates in relation to savings in real terms to savers, lenders. These induce more savings from the surplus units. By a similar token, borrowers benefit from lower costs as financial institutions become more specialized in financing activities. As firms themselves, financial institutions must make a profit from their activities, and this mainly comes from the spread maintained between loan and deposit rates. That is, ignoring for now financial institutions' own investment and other income-generating activities. Furthermore, and here I am considering this division of labor in all its aspects, such specialization has another kind of benefit, which, though it is captured in the discussion before, we need to emphasize. This is that with financial development, there is a tendency to substitute saving in real terms with financial saving, and this is reinforced to the extent that competitive rates are paid to savers. This results in the release of real resources that could otherwise be tied down, and to the extent that the costs identified previously associated with real saving are eliminated, financial saving lowers costs for society. Thus, to the extent that financial development not only raises aggregate savings, but also improves the channel whereby these savings are allocated to competing investments and raises the level of these investments, the capital stock is increased and output rises. That's it for today's video. I hope you found this analysis insightful. If you did, please like this video and don't forget to subscribe to our channel for more engaging content like this. As always, I appreciate your support. Thank you for watching, and until next time, stay curious and keep exploring the world of economics.